Hello and welcome, dear retailers. Today in the studio we are going to spread the information about liquidity hunting and stop hunts. This is episode 2 and we are going to clarify how this type of behavior in the market can affect our dealing process and where we are going to expect this type of behavior, how to validate them and how to use them, and so on. The points are very important in the stop hunt are included variety of points which I mentioned a couple of them right now, like validating them, why they happen, how they happen. So it's actually a type of balancing, creating a balance in the market and letting actually the liquidity or stop hunt is not an attack directly from the market makers to retailer traders. It could sometimes happen if there is a panic or a group of retailers entering in a one side because of that panic or anything, you name it. So everyone are trying to participate in one side of any market, so the market maker have to take the other side. So while they are providing liquidity, the market will reverse in that panic situations or in the very large participation of group of retailers. The other types are in the technicals, and while a variety of technical strategies signaling for one side, and again there is market makers who have to provide liquidity, and now it depends for this balance if that strategies are providing liquidity for the market makers are in one direction or both direction. So if they are in both direction, the market maker doesn't need to provide liquidity here. And if it's in a good zone for the participants to decide the direction of the market, there we have the build up. And in the build up, we have to understand which side are doing better. So when we talk about the stop hunt, it doesn't mean you or any retailer and your dealer you are trying to fight with each other. No, it's all about creating balance. And the first steps, as this is the only episode 2, as the first step to how to see them and validate them, you can understand it here. So what you have in my screen now, on your screen as well, is a very typical movement in the market. We see these markups here to have a solid mindset about them, and then we go to market to have a more realistic view about them. So we keep it very short, very brief. When the market touch a double high, double bottom 2 times and is not able to break them, so make a trend line like the right side of the picture, it means a energy, a participation, a validation of the strategy are carrying the market to reverse it. Or the trend line, the most typical and the most classic behavior of the market. These are 2 most classic, but our first signs of creation of liquidity to get hunted. 2 more behavior we have here are the ranges, when the market have a phase of movement and it extends and it gets tired. He get a pair like euro, a commodity like gold, he move 1%, 2%, and he gets tired for the day. So we are going to a phase of range, and how we have to verify and validate the liquidity side of the range. We have the range, we have the lower lows, higher highs, and these are the types of very simple at beginning. So that type of a couple of the lower lows, a couple of the higher highs, or the equal highs or equal lows are very common, but they are very important because they are the strong sign of participations. We have our first example here. It's very good to have a look at it very carefully. So what we see here, market have a really strong movement to the lower side. But if we have a closer look, what I want to show you here is this range here. We had the first extend, then we go for the range, then we grab the liquidity lower to go higher. So this is very important in the liquidity. It gives us a very tight stop loss and a larger moves, which is always fractal and every day in the market. So with this method, with the method of liquidity, it's absolutely not possible to receive 3 stop losses with these simple lessons even. So what we get in this point is in the range, we stop, we grab the hunt, we hunt the liquidity lower to go higher. So why the market do this? Why the market create this behavior in fractal mode? If we have a closer look here, in the more modern markets, we follow break of a structure more than trends, first touch, second touch, or third touch. The break of a structures, or that sides of smart money helps us more because that's more modern with these markets today. So he create this move and he go to the range in the box. So what we have in the box is very important. The box is a start. This is what we're looking for, because this is the first signs of from here. So the first signs of creating the range, resting, letting the participations to decide, letting the market pricing itself. And what the point I told you before, we have to in the range market understand. And look, these 2-3 points are odd. We have to in the range, we have to understand which side of the market we are looking for. As you see, this is the last. Let me make the pen a little. Last. Or here. This is the last point. We hunt it. The market hunt it. What we do is to participate it. So how we understand is the last. Imagine just we don't have the right side. We don't have this part. We have only here. We only have this. We have this box. In smart money, it's order book, but it's better to not look at it as order. Anyway, these pins. Look, these pins. The pin here, double pin. So we have another type of liquidity inside our range, which is the last point. When it's in top here, when it's here, the market, we don't know yet. But when he take, look, 1, 2, 3. We have 3 touches. It means it's validate himself. The pins up there are here also. So now when we come down, when this behavior below the range is showing us the market, the price have to come and mitigate and visit over it, surpass it. So when we have these doubles here, it means it will go back also. That's why in the video I mentioned, when you feel like the market is following you and it's the market rushing behind you to stop your stop loss, is exactly this one. Is not the stop losses, is the type of pricing and adjusting and balancing the market. And it's so clear in this example. So when we receive this higher, larger amount of liquidity below, market what have to do? Have to go up. Okay, we see the chart, we have the mindset, now the market goes up. But how to validate it? It will go up. Without validating also, we have the technical part here. But how to know that it give us a reverse without headache, without a stop? Look, these pins below the range, these pins, this behavior, he touch, they were a red candle. They were a high volume of selling, a high pressure of selling. So every time from here he come back, he sell, the market sell himself. Every time he come back, the market sell himself. You see? So this is here, sell, to sell, to sell. So, and here create the buy side. This is the same word when the participants have to decide, and when this range comes, when this type of liquid, we go to the phase of build up. So we understand here, after creating liquidity below, is not possible to go lower than this, except some unique examples. They are happening every day, but they are lower, they are less, they're coming from another source. But for this source, when we verify that tree low, that double top, that pins, that shadows, that push a phase in the, it's important, our phase is coming in the market opens, and a longer range, then a push. So when we take the lower, there is a rest liquidity higher also, right? When he was selling here, look, we have to have an idea of all the participants. So what this example is showing us, we have three participants: retailers, market makers, and algo traders. Who validate here? Look in this middle, the algo traders for selling, over 80% are ready to get position, or already they get their position. How they are getting their positions? Let me show you my pen. Here, look below this. This is the first phase in Fibonacci. This is the second phase, double top, sell pressure. You see, we can see it in the sensitive point of the market. We can see that type of behavior. So why we open this chart here and how we are surpassing this? This is because we can see it. We can see that liquidity provide. It doesn't mean they get trapped. Half of them are in negative. That's why we are participants in the markets. That's why we have to go to that beliefs. It's not the market following us to our stops. We are participants. We are here to find the right liquidity and let the market balance and pricing himself. It's about the economy of great countries, great economies in the world. So it's all about the pricing in this visible. So why it's a one candle? It could be the profit taking, or the one who was selling there down, closing the sales. But we want to go surpass it, and we see that type of liquidity created here. And here, too much sell pressure. So like the base of one, too much sell pressure, too much carrying. It's like you feel the shoulders or the baggage of the market with sales. You have to empty this to rebalance it. The market cannot never go in one day. So that sell pressure with the heavy volume of orders, you have to rebalance himself in this as like a smart money order block, or where the last place the deal happened before the imbalances. And easily here he create that without these markups, what the market see, what the algo is looking at. The algo see, the retailers see a new phase of selling. So after selling pressure, the market is ready to provide liquidity for the buyers. This buyer could be the retailers, this buyer could be the market makers, this buyer could be hedge funds, this buyer could be anyone. If it's a Euro USD pair for the Euro USD exchange, this is ready to give that in a normal day without any panic. Is ready to give the buy. Already the market moved a few percent, is very in a good position. He moved 2 levels and is ready to give his buys to the market, to buy back the market, He said, if you was yourself a market maker, when you sell all the day, at the end you are ready to buy back what you sold. So that's why we have easy example. Look below here. He just makes that mentality. He's running, I have to take it, I don't want to lose it. He's running. Not only to the retailer this dictate, to the greedy people it dictated, to the algos it dictates. He give the sell pressure to the timer of the algos. So he drop ticker lower, fast tickers. These fast tickers also is a trap. I don't say it's not a trap. Is a trap. The market must be complex. So these tickers, and the last place of the trap, this P, and also here is not a late time to enter the market. Is a very good position. Why it's a very good position? As I said, the classic movements of the markets, all of them, they get rejected here. So it's so good to take help from them. If I want to show you in a good example, I will show you with flip zone flip, in a smart money, in classic, in harmonic, in all the strategies. With the flip zone, it means there is already participants in the market to fulfill the other side of the trade. So if the market maker was the liquidity provider of the seller from the morning, now the sellers who didn't go back to the market maker or any sellers taking TPs, market maker buying back his positions, they are buying back. So any seller in the market now, until the next rebalance, is the liquidity provider. One, the retailer is the liquidity provider, the other, the market maker is the liquidity provider. So this is the point. We don't need to see the rest of the chart. We need to find these movements. If it was so complex for you, you think you need the easier touch, it's just, we have a range, a stop on lower to go higher. Stop on higher to go lower. If it was going higher, if he feel this imbalance here, so the market goes lower in 95%. So what will happen later? He will go. It takes time. He refresh the breath. The market had a like that extension for the selling, and in the next day the new market, the Tokyo market, comes and do this for us, rebalancing. This is actually the banking time. This is the new day rebalancing, and they sell so what. So he sell lower to go higher, and we don't need this much. We are not the guru, we are not the reachers of the market. So this is the liquidity. Market doesn't grab one liquidity to go to a direction for 6 days. The liquidity of a half of the session, take the liquidity, go 3 days. So it's good to put it as a target, not enter in this smart money trap. Why this smart money trap is validated is another point, but I said is in another day. Is not heavy volume of retailers, it's rebalancing, etc., etc. We have more examples, and we can go to check the charts in the live market as well. But these examples are from USD CHF, Euro USD, Pound USD, and gold. I think you get the overall, but I give you more examples to make sure what you get is right. Look here, I said that if it was a classic, if it was like 15, 16 years ago, it was a trend. But now it's like break of a structure. What validated trend? So this break of structures, and again, the smart money doesn't tell you this. If you're still working in smart money, but it doesn't tell you this range here. Same thing. This is same thing. You can enter here actually with a smart money, but I'm not a smart money trader to participate in this type of movements. But it's so easy to see that he come down. He left his liquidity here. These pins, again, the pins are so important. Why not this pin? Why? This is a good lesson for smart money. Why not this one? There's always a smart money traders ask, why not this order? Because this is the phase, this is the move. Like, I don't know, something happened, like a new iPhone comes, the price is higher, the old one is lower. You want to manipulate the market, like from the second hand to second hand, from the provider to this provider. You will never visit the old pricing. You'll never visit it. And that's why you don't have to visit the old pricing. You only have to find that like elasticity of the market and carry yourself in the right direction. And he validated his liquidity here, and he go down. But this is definitely a red folder news, which is not at all clear in the market, but it have tools that you can find the directions is very good for the red folders, but it's not the candle charts. And again, another one after a clear trend. It's so simple actually. If you look at it, he take the liquidity of trend higher and he go down. When the market have a really good direction, strong direction, these are very valid, and you can call it in the smart money like that order flows. Another good example here is very complex when you look at it, but you know the pins you have, the double top, the double low, and the range. Look how we verify our range. See, look, it was not a new trend in the market, no, it's here. He let something for it. Was a blue candle, it was a strong blue candle. We can later use the volumes, but it was a blue candle. It takes the participant and they go to the drawdown. Here also, the second touch, he didn't let them to go. Here also he didn't mitigate exactly so clear, but he dropped the pins. Drop the pins are so important. Drop the pins is even in double top or double lows can help you. Drop the pins is where you can enter. So again, the first thing, let me drop the box for you. You stop on higher to go lower. In this case, it happens I trade like this. Like I take this trade like here, so clear. If the spread didn't take you in the red folder, it will go directly to the profit so fast. Sometimes before you understand, it opens and you go to profit. And like this, and the other retailers are the middle, or in the smart money, they are in trap here. Again, stop on lower to go higher. And already he create this for us. Already create these pins. The pins have to take out. and take out. Same thing. The trend line, even if your strategy is giving you the side of the trend, never follow a trend line. This is more valid. Why this could validate himself is so good. Because we have a new direction in the market. We buy, we break this line, continue, we break first retest, second push, third push, this third push validate, 4 pushes, again, same thing, pins, same thing, we take this out, you go, same thing over and over again. So easy. Now it must be so easy for you to see. You know what will happen after. You take down lower, these pins, you take down. I don't know if I put the rest of this or not. You take down lower in build up phase. So when build up, I will give you this recap of the build up. After a strategy or something or a move of market maker is completed, you go to build up. Build up can be 2 hours, build up could be 2 sessions. But this type of build up is the best. This build up is really good for daily trade. 2 hours. He build up, stop on lower, he push again, he verify a lot of things, he validate a lot of things. Already he break this, push 2 of this, he will give us this to attract more participants, and he will go down. We cannot guarantee this leg because we have to see the behavior, but this with a good signal here, this is stop, at least 4 to 5, at least 4 to 2. Just take this, go here, 3, 4. It's a very small move, so you can see this maybe faster, and so forth and so on. And always, the point is that always when he go to take the trend line here, all of them, or double tops and bottoms, you see he don't want to let you to feel it's the right move to take the opposite side. He go with the sharp candle, he goes so strong. So this is why you see this is so strong, right? This is a very good example, so strong. But if you make it in a smaller scale, this was feel like that there, but he left the market participants with a shadow. So it's very important to know where the shadow will help and where this is in the body of the hunt. In the body of the hunt, it comes so sharp, and here he will give us the pins. Again, he comes sharp, pins, and he will go down. Right? So if someone is market maker, if someone is providing liquidity and his liquidity becomes so heavy, which is directing the market, you can see it with these sharp candles. You can see it when the market makers coming and the market is open for them, and they're providing or shaking the market. So they buy, they sell back, they sell, they buy back, and they have to keep that balance all the time. So this balance, this stop hunting is not following the stops, is rebalancing the positions. So you have to learn how this rebalancing is happening. So when you rush in a position, when you go heavy in a position in the market, you take the market in some place, you're like, all right, let's go back. You take our profit. So that profits, that's rebalancing for new position. If you're again market maker, stop the pins, you empty your positions here, you go down. You go again, you go down. Why you go again? To have a more elasticity, to have a larger moves, to not have a sudden moves. I think this is enough for the slideshow. I'm not sure there is something rest for the charts, but we will try to have a catch on the charts as well. Again here is a very good example. Very good example. It's so funny. It's so lovely. This is the same. This is when he's here. He's a look at me point. He said look at me. Look at me. From here to here is look at me. After, not in this box, like it could be a little in this range, like in this range you see this candle shadows. It means there is some rebalancing in that price is happening. It doesn't mean always is a like smart money moves or stuff. It's a rebalancing in the basis of the moves, mathematics, algos, market makers, the mentality of your market maker in that session. In that, if you see that, I think it's the same session, right? In the same, so close to the same session. But here is two sessions, is a London, New York. So larger. These small points we can analyze the market, but we must be brave to participate in the market. It's a look at me, but he didn't make a move. He rebalanced, stop and lower to go higher. So easy. Another phase here. Yeah. Is a look at me point. Is this? We have this. This our range is inside the, and this is the range. Come here. This is the lowest point of our is a phase. But our range, so he didn't go. He come back slowly and steady. He move slowly, in a smaller range. And this the end of range, why I don't take it from here, is a move. Look, it's a move. I don't have to take my range in the move. I verify like low. We are going sell. We are selling. Participate the other hedge funders, other algo is a sell, and pull it back, holding the market. If he come up, if he take this look, he drop here for us liquidity. But how to participate here? So super easy. How to be in this buy is a start here. When you see this one signature, this trend line, two signature, this range, how many people have stops here? How much important zone is up here? This big candle is showing a lot of traders was inside this, a lot of retailers. This is an absolute profit taking. So that was all for this episode. There is more videos, there is more lessons to make you know the atmosphere you are in, make you to be more comfortable with the place, be more friendly, and do not let the market give you panic. I know it's like a scary movie sometimes when you are trading, opening positions, but not really. It's a harmony, it's a beautiful movement, it's a dance of salsa, it's a going and coming and participating together. So it's good to know the value of the market you are in and participating. Thank you for being here, thank you for supporting, and I hope you take the best from this lesson, catch up and have a good time.